other market trends, two of our senior market analysts, Walt Hackney and Doug Jackson. Gentlemen, welcome back.
Good morning, Mark.
All right, well, Doug, let's talk about this wheat market. And we follow Chicago wheat here on the show, the soft red varieties. But and we've seen some, of course, a nice rally there. Then we're backing off the last couple of weeks. But the spring wheat varieties seem to really be jumping.
Mark, the September 30 production number cut the U.S. spring wheat crop sharply. We had record good crop ratings earlier in the year. We expected a record yield, a record crop, and it turned out to be damaged at the last minute and not nearly as big as expected. So the USDA will be incorporating some relatively significant changes in their subclass projections next week in the Wednesday supply-demand reports. We have a smaller crop of spring wheat, extra demand from Nigeria and Iraq due to structural, logistic, and political problems that have them buying Australian and U.S. wheat, even though there are a lot of cheaper wheats in the world. So the hard red situation continues to tighten, and the total wheat supply in the United States is not a great deal different now, as it turns out, to a year ago. So the wheat market's dealing with a lot of structural changes and fundamental changes of attitude here. We have dryness in the Ukraine. We have some questions about the quality and size of the Canadian crop. We have some dry weather in the U.S. And yet major exporter supplies in the world are still very adequate. Black Sea prices are way below U.S. values. The funds were short a record amount of Chicago wheat and long a record amount of Kansas City. The technicals moved enough that the funds covered that entire 40,000 contract short position at Chicago. Now they're even. We've had the rally. Now the question is whether U.S. prices are still so high versus the world that we'll see the funds come in and resell the Chicago variety, which has very, very poor demand and some of the lowest new crop sales in years. So we have a totally different situation in the subclasses, a generally adequate supply from a longer-term view. Prices at these levels are probably unsustainable, but you may see a lot more choppy price action as we've been seeing here in recent weeks.
Okay, for those subclasses, for the hard red spring wheats, you recommend making sales?
We actually think Kansas City could gain to 50 or 60 over Chicago, so that'd be another 20 or 30 cents from here. Minneapolis may continue to gain on Chicago. Everything's probably going to gain on soft wheat. But we might see some further strength in Kansas City, as I just said, but the soft wheat varieties probably are still overpriced and need to be sold right here.
All righty. Let's talk about the corn market, which, of course, we're in the full brunt of harvest is occurring right now, and typically we're seeing prices soften up some. Basis prices have been very terrible. Let's call it spade a spade for the most part throughout the Corn Belt. What's your advice to a corn grower right now?
Well, Mark, we're still in the process of discovering how big this corn crop is. Our estimate and other well-followed private analysts throughout this week, everybody's adding 200, 300, 400 or more to the current projection from September. We already faced a record storage problem with the September production numbers, particularly in the western Corn Belt. Now we're adding 200 or 300 or 400 million on top of that. Nebraska, Minnesota, and Iowa will clearly face a storage deficit problem this year that is beyond anything ever imagined, even much worse than a year ago. We have a transportation problem. We have sky-high car freight. We have sky-high barge freight. We have a situation that just cannot move the grain. And as you said, we're going to see record low basis values. The game here is really much as it was last year. People will take their LVP payments, 40 or 50 cents a bushel at harvest, generate a lot of cash flow. They won't want to make any cash grain sales. But the trick here is to make those sales for Jan, Feb, March, April, May, capture those carrying charges, this huge carrying charge in the cash market. You can net well above loan by doing so. The producer that has the space to hold the grain can capture those carrying charges and earn that. But selling into this very depressed, almost non-existent cash market in the nearby is going to be a very ugly thing to do, but we may get to the end of this storage problem, end of this harvest, and find out people will still have to make forced sales at unattractive prices. Unfortunately, the supply-demand situation this year may actually be more bearish than a year ago. We didn't have a 2 billion carryout estimate last year until February. Today, we're already imagining a 2.2 billion carryout or more. July corn futures went down to and below $2 last year, even after beans had rallied. Today at 232 roughly. They spent very little time above 235 last year. We would see July corn today until we get clear out into next summer as an up 5, down 25 items. So very little upside. Make those sales and lock that carrying charge in today. There's not much opportunity in the corn unless we get into a drought a year from now.
Let's talk about soybeans, where the picture has grown more and more bearish as this harvest, the soybean harvest continues as well.
Well, we again are seeing production estimates 100, 200 million larger than the previous guesses. That would give us a 300 carryout, maybe a 400 carryout. Certainly a situation that's significantly different than we thought. Yields have simply been astounding. 50, 60, 70 bushel beans in places where we thought we had a drought. The new management, the new varieties have astounded the trade, and we still have to discover the final crop size. But even at that mark, the general supply-demand situation in the more important Western Hemisphere, broader view, even with the larger private numbers we're dealing with now, will actually be slightly tighter than a year ago from what we thought at the time when futures were somewhat lower. So the fact is here that even if South American production rebounds some, the supply-demand situation may not really be that bearish at these prices, with cash prices near low. And the market's dealing with the phenomena that we may now be discovering in South America with their tremendously high freight costs into and out of Mato Grosso and the northern areas, with the high currency move that we've seen, their local currency, are now at a permanent disadvantage in terms of cost of production. The world needs 6 million more bean acres per year in South America to keep supply-demand in balance. Right now, we're projecting acreage will actually contract as their domestic economics implode on this soybean production situation. So we may actually be below the cost of production in South America, something that's unsustainable long term. So there may be less downside to the beans right now, but if we have a huge crop in the U.S., we may be really in the $5.86 range for quite some time.
All righty. As usual, some great insights. Doug Jackson.